You're paying a $55 resort fee, but the service has been cut. Why? Because MGM and Caesars, the legendary names you trusted, don't actually own these buildings anymore. They're just tenants on their own properties. They strip away the luxury, cut staff, and hike fees, all to pay rent to invisible landlords. This isn't business. It's a heist, and you're the one paying for it. For decades, Las Vegas was a kingdom ruled by giants. Men named Wynn, Adelson, and Kerkorian. They were gamblers and visionaries who built empires of light and luck in the desert. Their names were synonymous with the city's skyline. When you walked into the Bellagio or Caesar's Palace, you were walking into their house. But even as these men became legends, their companies became something else. Massively leveraged public corporations. The seeds of a Wall Street takeover were planted long before anyone noticed. A new kind of player came to town. They didn't arrive with cash and dice. They came with contracts and spreadsheets. They weren't interested in building empires, just buying them piece by piece without anyone really noticing. This is the story of how Wall Street engineered a takeover of Las Vegas, turning the city's iconic casino operators into high-paying tenants in their own kingdoms. The buildings they made famous are no longer theirs, and to see how it happened, we have to look at the deal that put this strategy on center stage: the sale of the Bellagio. The Bellagio isn't just a hotel, it's an icon, a statement. For 20 years, it was the crown jewel of MGM resorts. But by 2019, MGM was sitting on a mountain of debt, and Wall Street investors were getting impatient. They demanded the company become more asset-light, and they saw the billions of dollars locked up in MGM's real estate as lazy capital. The idea of separating casino operations from the real estate wasn't new, but this was the Bellagio. MGM's leadership went all in on a plan that would become the new playbook for the Strip, the sale-leaseback. Here's how the trap is set. Imagine you own your house, but you're drowning in debt. A company comes along and says, "We'll buy your house for cash right now. You can pay off your debts. There's just one catch. You have to pay us rent to keep living there." You get a huge cash infusion, but you've just traded the security of ownership for a permanent rent check. In November 2019, that's exactly what MGM did. They sold the Bellagio's real estate to the Blackstone Group, one of the most powerful private equity firms in the world, for a staggering $4.25 billion. That's enough money to rebuild dozens of schools, but it flowed into the pockets of Wall Street. Overnight, MGM had the cash it needed. To the millions of tourists who flock here, it looked like nothing had changed. The fountains still danced. But behind the scenes, everything was different. MGM now had to pay its new landlord, Blackstone, a starting rent of $245 million a year. And that rent would increase by 2% every year for the first 10 years. That's over $670,000 a day due before a single employee gets paid. This wasn't temporary. The lease has an initial term of 30 years, with options for MGM to renew. For the next half-century, a huge slice of the Bellagio's profits will flow straight to a Wall Street firm as rent. From Blackstone's perspective, it was the perfect crime. They didn't want the headache of running a casino. They just bought a guaranteed income stream, backed by one of the most famous assets in the world. They didn't buy a casino, they bought a cash machine. MGM sold this to the public as an asset-light strategy. But don't be fooled by the corporate jargon. The truth is, they sold the crown jewel of their empire just to become a tenant. The playbook was now public, and Wall Street was ready to copy it. If the Bellagio deal was the opening shot, the story of Caesar's Palace was a full-scale invasion. Caesars isn't just a casino, it's an American icon. But today, the company that runs it is trapped in a financial maze created by the very same logic. To understand this heist, you need to know Wall Street's weapon of choice, the REIT, or Real Estate Investment Trust. A REIT is a corporation whose only job is to own property and collect rent on a massive scale. Thanks to special tax rules, they are giant, professional landlords. Around 2017, as Caesars was trying to emerge from a complicated bankruptcy, a plan was hatched. They didn't just sell the buildings, they spun off the company's real estate and created a new monster to own it. Its name? Viti Properties. Viti as in Veni, Vidi, Viti, I came, I saw, I conquered. The famous words of Julius Caesar himself. They weren't hiding their intentions, they were bragging about them.
Viti was born owning the very buildings Caesars had spent decades building, including Caesar's Palace. The company that operates the casinos, Caesars Entertainment, now had to sign a master lease, promising to pay VC rent on the properties they once owned. The numbers are designed to make your head spin. Caesars' initial fixed annual rent to VC was about $630 million. Before Caesars can make $1 of profit, before it pays its thousands of employees, before it renovates a single room, it has to write a colossal check to its landlord, VC. That pressure is where the real consequences begin: higher prices, slashed staff, and those infuriating resort fees. VC properties, along with another major casino REIT, GLPI, have become the new invisible kings of Las Vegas. Today, VC is the largest owner of high-end resort real estate on the Strip. Its portfolio includes Caesars Palace, MGM Grand, and Mandalay Bay. This is how the casino real estate market was captured, a critical part of Wall Street's takeover of Las Vegas. The heist was now systemic. They had sold their kingdoms, only to be forced to pay a king's ransom in rent forever. So who are the new kings of Vegas? Their names are Blackstone, VC Properties, and Realty Income. They are the invisible landlords, and their business isn't the glamour of Las Vegas, it's the cold math of Wall Street. To them, the Bellagio's facade isn't an icon of entertainment. It's an experiential asset. That's the language they use. You, the tourists on the Strip, aren't guests. You're the revenue stream that guarantees the rent gets paid. The casino isn't a destination, it's a mission-critical asset, meaning the tenant is locked in and can't leave. Their model is built on the triple net lease, a perfect trap for the tenant. In a normal lease, the landlord pays for things like taxes or major repairs. But in this scheme, the tenant, the casino operator, pays for everything: property taxes, insurance, maintenance, a new roof. It's all on them, on top of hundreds of millions in rent. The landlord's role is simply to cash the checks. This creates a beautiful, low-risk investment for them. They have a world-class tenant on a decades-long lease, paying all the expenses, with automatic rent increases baked in. It's a fire hose of passive income. This has turned the Strip into a portfolio of financial instruments. These properties are now just trading cards for giant corporations. In August 2023, Blackstone proved this by selling a 21.9% stake in the Bellagio to another REIT, Realty Income, in a deal valuing the asset at $5.1 billion, flipping a piece of their investment like a stock for a massive profit. The Bellagio is no longer just a place, it's a line on a balance sheet. What tourists see are neon lights. What Wall Street sees is rental income. The old kings were driven by ego. The new owners are driven by a single metric: yield. So, what is the real cost of this takeover? The lights are still on, but this new ownership model has created a system that is far more fragile than it appears. The biggest change is the massive, inflexible costs. Companies like MGM and Caesars now have colossal rent payments that are due no matter what. In the old days, if a recession hit, an owner would see profits fall, but their core costs were manageable. Now they have a multi-billion-dollar anchor tied to them. The COVID-19 pandemic was the ultimate test. As the Strip became a ghost town, casino revenues dropped to zero. Yet, the rent was still due. The REITs that owned the properties were protected. It was the operators, the companies employing tens of thousands of people, who took the full brunt of the crisis. This fragility was exposed again in 2023 when cyber attacks hit both MGM and Caesars, crippling their operations. It was a devastating blow. But for landlords like VC, the contractual obligation didn't change. The rent check was still due. This is the dangerous dynamic they've created. The operators are always on the back foot. When profits get squeezed, the pressure to cut becomes immense. The first things to go are staffing, maintenance, and the quality of the guest experience. The relentless need to feed the Wall Street rent machine has bled the very operations that make Vegas Vegas. This is why your vacation feels more expensive while offering less. The costs of this casino real estate scheme are passed on to you and the employees. Ultimately, the takeover succeeded by separating the asset from the risk. The Wall Street firms own the stable, appreciating real estate. They collect steady income. The casino operators are left with the logos, the operational headaches, and all of the risk. They've been left holding the bag. The story of Las Vegas over the last decade isn't one of decline, but of dissection. A deliberate, silent takeover has occurred, not by force, but by financial contract. The city has been carved up and sold for parts. Las Vegas wasn't lost. It was restructured. The land, the buildings, the cash flow, and the risk now all belong to different people. Wall Street firms hold the tangible real estate. The iconic casino brands are left to manage the volatile business of a resort. And everyone else, the employees, the city, the customers, are left to deal with the consequences of a system that prioritizes rent above all else. The neon lights that once symbolized bold ambition now just illuminate a city-wide, multi-billion-dollar lease agreement, the final prize in Wall Street's takeover of Las Vegas. This is what happens when real things, from houses to hospitals to the entire Las Vegas Strip, are turned into abstract financial products. It leaves us with a profound question. When everything is for sale, are we still citizens living in a community? Or are we all just temporary residents in someone else's investment?